Welcome back to Investing Talk Podcast.
Today we're looking at Oklo.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. The core story here is it's advanced nuclear energy. Specifically, we're talking about microreactors and fuel recycling. But the whole narrative is kind of split between this massive long-term ambition and, well, some really volatile near-term financials.
That tension was immediately visible in the last quarterly report, wasn't it? What were the headline numbers that, spooked the market?
Absolutely. The third quarter results showed a greater than anticipated loss. The loss per share came in at negative 20 cents.
20 cents. And what was the forecast?
The consensus forecast was negative 13 cents. So pretty significant miss.
Right. And that resulted in a stock price decline of about 6.5% in aftermarket trading.
It did. It's a stark reminder that this is still very much a pre-revenue technology business. They're still in that heavy R&D and construction phase.
Exactly. But despite the losses, there was some really strong news on the execution front. What are the milestones investors should be focusing on that, counterbalance that financial miss?
The biggest news is all about de-risking the actual construction timeline. They recently broke ground on the Aurora powerhouse at Idaho National Laboratory.
So they're actually digging. It's moving from paper to the physical world.
Precisely. And just as crucial, they secured a binding contract with Siemens Energy for the power conversion system. That includes the SST-600 steam turbine and generator.
And securing a turbine from a major player like Siemens is a huge deal, isn't it? It mitigates a lot of that long-lead procurement risk.
It's a massive deal. You're mitigating major supply chain risks. You're not trying to reinvent the wheel on components that are already proven.
It sounds like the key shift isn't just what they're building, but how they are getting approval to build it. Can you walk us through some of the regulatory changes that are really accelerating their timeline?
This is where this story gets, I think, really interesting. The company was selected for 3 projects under the Department of Energy's new reactor pilot program, the RPP.
Okay, the RPP. So what does that alignment with the DOE practically enable them to do faster?
It completely changes the cadence of the build. So the DOE pathway allows them to actually begin construction and initial operations while the longer commercial NRC combined license transition happens in parallel.
So they're not just sitting around waiting for years.
Exactly. It significantly reduces that idle time, that valley of death for these projects. We saw evidence of this acceleration when the NRC accepted their principal design criteria topical report in just 15 days.
15 days? What's the typical time for that?
It's about half the time you'd normally expect. So it shows a really strong alignment.
And based on that, they're targeting operations for the Aurora INL powerhouse by late 2027 to early 2028.
That's the target, yes.
And this DOE authorization, it doesn't just apply to the Aurora reactor, but also to their fuel fabrication component, correct?
That's right. The DOE approved the Nuclear Safety Design Agreement for their Aurora fuel fabrication facility in less than 2 weeks. That's a record for the fuel line pilot program.
Wow.
It reinforces that federal support for their whole vertically integrated fuel supply chain, which is so critical for future deployment.
Okay, let's talk about that fuel supply. It really seems to be their major competitive moat. How is the company addressing this complex challenge of securing fuel for advanced reactors?
They have a multi-pronged strategy. So in the near term, they're using existing DOE materials, including recycled fuel from the old experimental breeder reactor 2.
Right.
But the mid to long term is all about recycling. They announced an investment of up to $1.68 billion in the Tennessee Advanced Fuel Center.
And that's going to be the nation's first privately funded fuel recycling facility.
The very first. It's a huge step.
The other fascinating element here is the potential use of government plutonium. What is the scale of that opportunity?
It's a complete game changer. I mean, the government is making up to 20 tons of surplus plutonium available as a bridge fuel source.
20 tons.
And the company believes this material could be converted into about 180 metric tons of Aurora fuel.
That's an incredible amount. What does that mean in practical terms?
It could potentially fuel their first 10 to 20 plants. And it almost completely negates the immediate need for uranium enrichment, which is a huge bottleneck.
So they can sidestep that whole enrichment process.
For the first fleet, yes. The process involves blending the plutonium with unenriched uranium to create this high-performance fuel. It avoids a lot of the cost and time of enrichment.
That's an astonishing amount of potential fuel inventory. Are they also strengthening their ties internationally to bolster this supply chain?
They are. They signed a strategic partnership with Nucleo, which is a big European advanced nuclear developer, and also Blycala.
And what's the goal of that collaboration?
The goal is to develop fuel fabrication infrastructure right here in the U.S. Nucleo is planning to invest up to $2 billion through an affiliated vehicle. It really strengthens transatlantic energy cooperation.
Okay, we've covered the impressive progress, the technology, the regulatory wins, but we have to address the significant risks here.
Absolutely. Despite all the technological and regulatory progress, the company remains pre-revenue. Its valuation is highly speculative.
Right, the market cap is quite large. It's trading at an elevated 11 times book value, while, expected revenue is basically zero for the near term.
And that brings up the question of funding. How are they funding their $65 to $80 million annual operating cash burn?
Let me guess. Equity raises.
Largely through equity raises, yes.
Mm.
They ended the third quarter with $1.2 billion in cash, which is a huge cushion.
That cash came in part from an at-the-market offering that generated $540 million in gross proceeds, right?
It did. But here's the other shoe. They also recently filed a massive shelf registration to potentially offer up to $3.5 billion in various securities.
$3.5 billion. That just screams high risk of future dilution for current shareholders.
It's the clearest signal you can get. These projects cost billions, and this is how they'll fund it.
And that dilution risk, it's compounded by insider activity, isn't it?
It is. Over the last 90 days, there has been significant insider selling. For example, the CEO sold 300,000 shares.
And the CFO.
The CFO sold over 92,000 shares. Now, while insiders still have substantial ownership, this kind of planned, systematic selling can really weigh on investor sentiment.
It definitely suggests that insiders are taking some profits off the table while the stock price is elevated. That's a tough look for a pre-revenue company.
It is.
Okay, let's finish on the commercial outlook. The huge demand driver here is the need for baseload power for data centers, driven by AI. What does their pipeline look like?
The potential demand is, it's just massive. Yeah. The company cites a non-binding pipeline of over 14 gigawatts.
14 gigawatts.
That's a huge number. And it includes previously announced agreements with data center operators like Switch, that's a 12-gigawatt letter of intent, and Equinix, for 500 megawatts.
So this pipeline directly links their technology to what is basically the fastest growing source of power demand in the country.
It does. It validates the whole thesis.
So, given all these moving pieces, the accelerated licensing, construction starts, the fuel recycling, what are the immediate catalysts investors should be watching for over the next few months?
The immediate focus is just execution. We need to watch for the completion of the Aurora INL site preparation. The excavation is targeting early January.
And on the regulatory side?
Look for the NRC to issue the draft evaluation for that Principal Design Criteria report in early 2026. That's a huge checkpoint.
And of course, the big one.
The big one is any positive updates on converting those 14-plus gigawatts of non-binding agreements into firm power purchase agreements. That will be the major catalyst that validates the entire commercial model.
So this is definitely a high-stakes investment. You have a company that's executing complex engineering and regulatory milestones faster than expected.
Backed by $1.2 billion in cash and focused on a trillion-dollar market in AI power demand.
But that progress is built on a mountain of risk. You have dilution, zero commercial revenue for years, and a really volatile sentiment.
And what's fascinating here is that the policy shift, allowing them to build in parallel with licensing, has structurally de-risked the regulatory timeline. But the commercial risk, securing firm contracts and managing costs, that remains front and center.
You're essentially betting that this accelerated path to operations will lead to a rapid conversion of that massive 14-gigawatt pipeline into decades of predictable revenue.
Yeah.
And this raises an important question for you, for our listeners. Does the strong balance sheet and the regulatory momentum justify the risk of buying a company that's years away from profitability? Or is this still too early in the cycle?
Something for you to mull over.
And if you want more discussions like this, be sure to hit that subscribe button. We'll catch you next time on Investing Talk Podcast.